Hey guys, welcome back to the Capital Mindset Show. We are your hosts with the most, Austin and Fabio. And today we're going to be kind of walking through live for you guys on the Chewy.com stock, ticker symbol CHWY. We're going to be kind of giving our opinions. We're going to be diving into the numbers, the products, exploring the moat as well as the industry. And then we're also going to be plugging it into our discounted cash flow analysis and just sort of giving our opinions on this. So without further ado, what are we looking at here today?
Okay, that's a new sound. All right. So let's just first take a look at the classic stock price movement, because everyone wants to know, why are we even talking about this? Well, we were asked by a subscriber before we begin.
Yep, this is a subscriber request. So thank you. Subscriber request.
And I saw we got a subscriber request that apologized for asking for so many. No, don't apologize. Keep asking.
Yeah. Keep asking us.
Yeah, don't apologize for that. You can ask us as many as you want. We just have a list.
And also for those of you who've asked and it's been a while, we have not forgotten. We are getting to making them all. So we're getting through
the ones that are taking longer are the ones that are in IFRS, which I'll announce one of them, IBKR. I know one of you asked for IBKR. We're getting that video out soon. That's on our priority, and we've been working on it. All right, so Chewy, it's down from its all-time highs for about 43%. It's been bumpy. So that tells me, deriving a story from the numbers, that perhaps the valuation was tested at these higher levels, and now we're approaching perhaps more fair value, or the valuations actually come down, because this right here seems like over exuberance. I remember when it first IPO'd, and Jim Cramer was all about this. He's like, Chewy, you got to buy Chewy. And then he was like, he was like, saying like, the CEO knows how to treat his customers. He sent me a letter when I adopted my dog. And then I was like, oh, cool. Because apparently Chewy does that. And I remember Chewy being compared to like pets.com, which is, far cheaper in valuation, but it probably deserves that, because Chewy's attacked the customer in a way that really no one else has. And Chewy's management team, I know, has infamy, or not infamy, but are famous for execution. So we have before I begin, my initial impressions without looking at anything, and I haven't looked at the DCF model at all. It's a good company, but we have to separate the business from the stock price. We have to see if the stock price aligns, right? But in a lot of times when there's a really good business, it's not a secret, and the market knows this, right? So the market knows it's a good business, so it's priced typically according as such. Not always. We see here right now a P ratio of 3,000. For our longtime viewers, please don't judge it ahead of time, right? Because remember, that's GAAP accounting. So there are some limitations to that, especially if a company's kind of new. They may be recording losses on an accrual basis, but maybe not actually experiencing those losses on a cash flow basis. So they might be bringing forward some losses from previous years. So that being said, is such as R&D. I just want to explain that because I don't want to just leave it there. So that being said, what are we looking at today, Austin? Can you show us the annual report?
Yes.
Or presentation?
Yes, I will. I'm actually going to show instead. I'm actually going to show instead the actual website and just sort of what the website is and some of the products here, and then I'll move over to the letter to shareholders. So basically, what we're kind of looking at here, just as a live preliminary analysis of this, is I'm seeing a website here that's kind of structured like a Walmart or an Amazon of different pet supplies. So, you got this looks like to me medicines. They got vitamins and then different toys, I would guess, for cats. So yeah, as you can clearly see here, but if I click here, basically, so anytime I'm ever trying to understand a business, I like to go directly to the business's website and then just kind of like mess around and kind of see what they do. And then from here, kind of pull out like the nuance onto this. Yes.
All right. So what we're deriving from here is what's their target market? Who are they targeting?
Pet owners, obviously.
Pet owners. Okay. Not the pets, right? They're not targeting the pets. They're targeting the pet owners. Okay. So, what's the market size? Do we know what the market size is? And if not, I'll leave you and then you can come and check back on us.
Yeah. Okay. Size. I don't know what the market as a whole is, but I know the market cap for this particular company is something like 30 billion.
Austin, what's the market size? Not the market cap. We don't care about the market
size.
Cap.
All right.
So leave us in tell us what the market cap is. So while Austin's finding that, what we're going to do is kind of digest, or I'm going to digest and with you guys digest, hopefully, what's, pun intended, by the way, what's Chewy selling. Okay. So they're basically targeting, we know they're targeting pet owners, right? So the pet owners right now, in a lot of countries in the West, people are, having less kids, maybe adopting pets more. So I don't know if you guys know that, but in Europe, that's basically a lot of the cultural trends, less children. Pets are almost like becoming children. It's maybe it's weird for you, but if it is, I'm sure you're actually not alone in thinking that. But pets are becoming more and more important part of people's lives. They're caring more and more about their pets. That's basically generally the trend. We see, for example, General Mills made an acquisition of Blue Buffalo. So they actually started investing heavily into pet snack foods, et cetera, because they see also an opportunity. So Austin, did you find that? What's the market size?
So I basically, what I found here is that, the pet spending has pretty much grown from 73 billion in 2014 to 98 billion in 2020.
There we go.
So this has been growing at about 5% per year, and they're projecting this to 2024 to grow at a rate of 6%. So hopefully that answers your question.
It does answer my question, because pet spending, because Chewy is not just food.
Yeah.
Chewy is food, toys, medicines, etc. Because pets.com, right, is mainly medicine. It's a pharmaceutical place where I think they may sell other things, but from what they were known for, it's medicine and vitamins and that such. So there also is a company, we can look at that. Can you look up the one that Pfizer spun out? So Pfizer spun out a pet medicine company or pharmaceutical company, and tell us the name of that. I forgot the name of it, but I remember they did that. And that kind of coincides with this market in a way. But we're focusing on Chewy here. So Chewy distributes and sells. Think of them as like the Amazon, but I hate using that word because it's overused, that example, but it's a retailer. It's an online retail distribution for pets, right? So
I think the name of that company, by the way, is Zoetis. I think is the name of this.
Was
Zoetis
it spun out from Pfizer?
Yes, it was.
Okay, then that's the one. It's a pet pharmaceutical company, right?
Yep. Yeah.
Then that's
at least
the one.
That's
It should be publicly traded. Do you see the ticker? Maybe show us the stock price, how that one's done, because that kind of gives us an idea of the broader industry. Because remember that if Chewy is selling medicines, vitamins, and stuff like that, they may be selling also these medicines as well. Or if they're not, it could be a potential going forward for them to do that. All right. So I go on the max. This is definitely, okay. Cause I know it did not IPO at 200.
No. Yeah. It was
that's
like
fantastic.
And then it was boop, 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 boop.
Yeah. So this is kind of like a case study of the broader market or spending for pets, right? So if pet spending increased, so has the medications for pets, because if your family friend is getting old and dying, you're more willing to fork over the dough, for lack of a better term, in order to prolong their life, make them feel better, etc. So we can see there again, don't judge it ahead of time, but the P ratio of 52 does imply it's a little bit expensive. Dividend yield of 0.46. That's a very low cute yield. But that being said, it's kind of indicative of the broader market spending. So Austin, go back to the go show us the annual report or annual letter to shareholders. Share that with us, and we can talk about that. So
it's good. Just got to find that for a quick second. Boom, found it.
All right. Cool. So interesting prospects so far. Growing industry. I like all that we're seeing so far. Now, as far as the valuation, we'll see that in the model. So remember that we look at these documents to show us basically what management wants us to focus on. Okay. So if it's not good, then that should be a huge red flag, because this is supposed to be like their sales pitch to us. Now
we should look deeper into this there. We should, not that's like an area of concern, but would this be in this particular industry, would this be indicative of a low gross margin here?
No, not at all.
No,
think about it.
No, because they have actually,
let's actually unpack that. Yeah. Why did you say that?
I mean, at least to me, coming from the accounting side, it seemed like they were spending a decent amount to produce the to produce the goods that were then later sold, which is why we're seeing this lower number here. But you just said that that's not really an issue in this instance.
Well,
so
what do you mean?
I'm kind of curious as to
what do you mean produce?
Yeah.
No, because
like,
this is by the way, guys, this is again raw. This is me and Austin exploring, and hopefully you guys are exploring with us and kind of discovering this company. And maybe we're answering some questions between our dialogue. All right, so Austin, let's pinpoint what you're trying to say there. What are you saying by production or produce for this company?
Well, I mean, in order to have a gross margin at this rate, you would have to have some sort of cost of goods sold or cost of revenue. So now I'm curious as to where most of these costs are going to if the gross margin is
correct
low here. And that so that's just something that I just want to check into. So
yeah. So by chance, do you know Target's gross profit?
No, but let me find out. I don't know that off the top of my head, but let me find
out.
I'll
get it in 2 seconds for you.
Okay.
Because so Target's is 29, Wayfair's is 28. All right. And if I wanted to shove in, for example, or I wanted to ask you instead, what do you think Walmart's is?
Well, now that we're kind of in this ballpark, 32, 25.
Walmart's is 25.
Okay. So we're kind of looking at a gross margin here that isn't really an area of concern because of the nuance of the industry that it's in.
Perfect. Because what exactly is Chewy doing? What exactly?
Chewy is, hold on. Chewy is selling these pet supply products to consumers. They're selling products.
Correct. Yeah. So they're like an online retail focused distribution, but retail is the key word. So when you look at the gross margins, are they more or less in line with other peers like Target, Walmart, even though they're not specifically in the pets food? Chewy's a focused retailer, but they're in line, right?
Yeah, they are.
Okay. So that was just a quick, so you see there, guys, we're discovering or kind of exploring the numbers and metrics and trying to see if things kind of make sense. So the net margin is negative, right? But that's on a GAAP basis. And we'll discuss that later. A net loss of 16.7 million. So, that's not a good, this one's not a good thing right here. Adjusted Ebitda. All right. That's a classic advertising number that they love to use, right? Because here, interest, taxes, depreciation, amortization. Okay, so we can argue on depreciation, amortization, but even though those are actually real costs, we want to include those, right? And we include those typically in the CapEx, capital expenditure. But you don't want to simply deny that those costs exist, right? And what about interest and taxes, right? You're not going to pay that?
Yeah.
So Ebitda only matters, right? It was designed in the 1980s for the acquisition of an entire business, right? It was designed for the credit markets of the 1980s and is basically supposed to be used in tandem with enterprise value. So it's enterprise value to Ebitda. If you see someone using that metric, that's more reliable or more credible than Ebitda to like market cap, right? And Ebitda as a standalone doesn't really tell me much. It tells me, what would happen if I bought the entire business, paid off all of the debt, and then that's what you use that enterprise value for. And then that kind of gives you that kind of valuation metric, enterprise value to Ebitda. But if you're not buying the whole company, you're just buying shares, why would you care? I don't really care.
Yeah. So now my question for you, and this is actually a legitimate question. I actually did not know the extent to depreciation playing a role in CapEx. I legitimately thought CapEx just dealt with the actual costs incurred to maintain factories or to purchase new factories or to, not factories, but factories and all of those other things. But I didn't even know that depreciation played a role in that there. So,
all right, well, let's unpack that. Okay. So if I buy more equipment, that goes later into my depreciation costs.
Yeah. Yeah.
Right.
Okay.
There you go.
Yeah.
So you'll expense that over the life of the item. So that's the depreciation, but that's CapEx. So when we measure cash flows, we're already kind of including that. So you want to be careful because depreciation is a real cost. Okay. It's a real cost It's just the way it's done. It's a non-cash cost because the cash is done during the CapEx moment. You bought the equipment, right? You purchased new equipment, capital expenditure. And then you expense it on a GAAP basis, and that's depreciation and amortization, right? So that's, you know, why you have to be careful. That's a little bit of the nuances. So hopefully that provides value to everyone watching, the nuances of accounting and why you have to kind of sometimes, well, it depends on, let me say that it depends on the industry, on whether or not I'll trust GAAP more or whether I'll look at the cash flows more, because I think we have reviewed some businesses. I not off the top of my head, I don't remember, but some businesses I will actually look at the GAAP more than the cash flows. I think it's where, well, I know a good example perhaps is like builders. For builders, I'll actually look at the GAAP EPS or the GAAP net income over cash flows. And we should do a video on some builders, and then we can talk about that or unpack that further. But like we've been saying, investing is very nuanced. Okay. So some people apply the same box, the same little box to every single stock. And then what you'll notice is if you try to do that, you're going to fall flat on your face in some cases. And you'll ask, well, why? I applied my little box and the little box didn't work. Well, because investing is nuanced. Every industry is different. So basically that goes back to Buffett's lesson. If you understand something, stick to that. Don't kind of deviate away, because what Buffett's actually saying there, but not directly saying it, is investing is so nuanced, right? That some industries require different levels of understanding, different levels of analysis. That's what he's saying. If you really break into his statements or what he's saying by sticking to what you know, if you unpack it, he's basically telling you to do that, right?
Well, I think also what he's saying too, and it's another crucial part, is just being confident and just standing on your own 2 feet. If you arrive at a decision, being confident in that decision, and then not allowing just the tides of the herd to steer you off course from that decision.
Well, I agree with that, except when he says, like, for example, if he doesn't understand it, he stays away from it. Well, what he's saying is his level of analysis may be appropriate for this entity or this industry, but not necessarily applicable to this other industry that he's looking at. He's very choosy with his words. Okay. So, but exactly that too. He also says that, like, you don't want to, you want to be confident in your investment so that you don't make emotional mistakes. Okay. So everything here is, you know, okay. They're growing at 29%. So we'll actually put a pin in that 26%. There as well. So let's range that between 27%. We'll remember that for our model, everyone. And then it's always nice when they do a letter to shareholders. Some companies don't. It is.
It's very flattering. You know, I like this a lot.
Yeah, it's indicative, or can be indicative, of a management that actually kind of cares about you. But it's not proof that they do. It's just, you know, like a little hint. All right. So Chewy Health. So you see, like, they're investing in the health market of the pets. So they understand that that's happening. Okay. Clinics, right? Which currently are using more than 8,000 clinics around the country. Okay. Very good. Continue going down. Facility investments. Chewy proud to progress of our pet healthcare. Okay. So same keywords, rapidly expanding total addressable market. Cool. They're going to use that word a lot. Total addressable market, classic marketing, for their stock. Let's scroll down more. All right. So diet, pharmacy, compounding medicines, telehealth, passive prescriptions. Some of those are like keywords, but some of those are important. So like veterinary diet. So food. I know, for example, Tice's mother, she has a dog that has a lot of intestinal problems. So he has to eat special foods. So with that being said, they're probably maybe, I actually know they're a customer of Chewy. I've seen the Chewy box. All right, scroll down. All right. Yep. Remember, so let's skip through the stuff that we don't really need.
Yeah, this is all the same stuff that we've been seeing. Adjusted EBITDA.
Okay, no. We got to stay to adjusted EBITDA. That's a very important number.
Free cash flow.
Free cash flow. Okay, but we got to be careful how they calculate free cash flow, because free cash flow is a non-GAAP calculation. Be very careful when you're looking at non-GAAP calculations and how they're calculating non-GAAP calculations. But in good faith, we'll just trust it. 60 million. We're going to just trust that. All right. And that's Q2 2021. Remember that it's Q2. So it's not the full year.
And he's thank you, blah 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 blah.
So
sincerely, blah 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 blah. Yeah,
we can move on now, I guess. Or
got the
is there anything?
sheet.
Oh, okay, no, we want to see this. So real quick, let's skip down to we see the cash equivalents. Okay, it's going up.
Yep. Yeah.
Go down to the debt. Let me see that debt. Let me see that puppy. All right, cool. Liabilities, total liabilities. If it doesn't show up, they sometimes don't have it. Okay, operating lease liability. So this is new from those changes in lease obligations. So they report that now.
That were done last year?
Yeah. So
as we changed it last year. Yeah.
And okay, so here we have multiple classes of stock. Total stockholders equity deficit, additional paid in capital. We don't care about that. Okay, so they have preferred stock issued. Okay, but that's a debt. Actually, that's their debt. If they don't have a long-term debt, that's actually their debt because preferred stock is a form of debt.
Yeah.
And remember, preferred stock has obligations to dividends, unlike certain other entities that we've been talking about.
Yeah.
So class A, class B. So you have economic interest, shared economic interest, and equal parts. I think one of them must be the founding shares, and the other ones is the ones that are traded on the stock exchange. And typically, it's B that's founding shares. A is the ones trading on the stock exchange. By the way, if you didn't know that, that's usually like a trend. But let's not talk about that. So shares issued. Okay, so that's fine. So we know there's two classes of stock. We'll have to make an adjustment later. Let's scroll down.
Also got our lovely income statement here.
Okay, let's skip all this. We don't need this. And then I think that's pretty much.
We've got
cash flow statement,
cash flows,
net cash operating activity. So the cash flow positive and operating, and then CapEx. So then they're positive currently in August. Okay, so they're positive this year. So they're positive for 26 weeks. Okay, so nice. Yeah, that's good. We should see it positive for the full year when we look at the numbers in the model.
Cool.
Cool. We don't really. Oh, go up to the shares. I want to see dilution. I forgot to ask about that. Dilution. Yep, there's dilution occurring. All right, on the class A, we can see that. And then class B dilution as well. So, yep. All right, we'll see dilution and we'll probably account for that in the model. All right, I think we can skip over
now I'm also kind of curious too to kind of see the way economic interest, if there is any, or voting interest is kind of broken between the classes of stock. But that's just kind of my own mind just looking into these sorts of things.
Normally, it's going to be even. There's going to be very few rocket companies out there. Yeah. Remember, Rocket Companies is an American VIE, American VIE. However, in that VIE, you actually have economic interests, and your economic interests are tied to the real shareholders, or because you are still a real shareholder, but it is a VIE. VIE is a very broad term. Okay, it's variable interest entity, so it's an American VIE. And if you followed our channel that we've talked about VIEs in the past, that video is an interesting video. You can see an American VIE, and I can tell you that is safer than the other VIEs we talked about. And, that's still saying a lot. All right. So let's go over to the model now, and we can start to make some assumptions. So before we begin, the data is aggregated in here in an interesting format where we're going to have to make an adjustment. Okay. And that adjustment, let's see here. So yeah, I already plugged it in. And this is where we see the market cap and the actual market cap. So we can do a quick division. And then that's about 7 divided by 27. Some rough maths here, guys. So 25%. So we go back to our input here, we're aggregated, and we multiply this number by 25%. Well, let's round. It's actually 25.9%. So
and then also, in case the audience is not following this math lesson that's occurring right now, why are you multiplying this by 25%? Would you walk us through that a little bit?
No, you just have to trust. No, I'm kidding.
Fair enough.
So 26 times 124.7, so 32.422.
Just make sure you add that negative sign in front of it. Yeah,
I did.
There you go.
No, the CapEx is positive. All right, so
it's income. It's an expenditure that produces income.
They get paid to get new equipment.
Yes.
All right. So the reason why I was doing that was I was making adjustments for what the class of shares that we can buy, right, on the market. So if we buy Chewy, we have ownership over that much of the cash flows, not the whole full amount. Right. So we have to plan out for that. Ignore that it's negative. It's negative because we're not discounting by anything. So we actually have to start to discount. So let's start with the 10% standard. And let's actually, what was the growth rates that they're pulling out right now? It's like 27%.
Yeah, I think that was about it. We can also take like the pet spending industry too, kind of use that maybe as like a floor there as well. So about 6%, I would say.
6%. Nah,
yeah.
That's
well,
way
no.
too low.
I mean, like that's like our like minimum threshold. Like we use 6% as our minimum threshold.
Austin, let me just tell you, look what happens. 6%, terrible. Because okay, so what's going on is they're going to be experiencing like efficiencies. That's the theory, right? So their sales are growing at a certain amount, but their cash flows are potentially going to be growing faster, right? Because we just saw here's my point. If everyone remembers what we looked at in the statement of cash flows, they were negative for quite some time, right? But only now they're becoming positive. So how do you calculate the growth of a negative to a positive? Well, that's tremendous growth, because before you're losing money on a cash flow basis from all of a sudden going to making money on a cash flow basis, right? So while the revenues are growing at about 27%. So the cash flows arguably are growing much faster, right? Now we'll see a time where that will slow down, but I think for a time we're going to see a much faster growth in cash flows, which is what we're going to have to adjust for. So I think, for example, this is not unheard of, but about a 40, and let's say in a crazy amount, let's say 100. Okay, so what I'm trying to see here is play around with the model, and it's going to be telling me, okay, 100 is probably way too much because it's not going to be that at 100. So let's actually see with 60. Okay, so this is what the market's kind of pricing in right now. So the market is pricing in, if you believe a 10% rate of return over the course of 10 years, it's pricing in 60% growth in cash flows moving forward. And that would be about today's price. Okay, so I'm assuming, so now I'm assuming like that's like our base rate for what the market is pricing in, or what we have to assume the market's pricing in. And that's the expectation we can receive. So I kind of worked backwards. That if everyone's following along. Are you following along, Austin?
Yeah.
All right.
Yeah,
just
I
in
am.
case
I'm also checking through the annual report right now, just to kind of see the way that the two classes of stock are broken down. And it seems that they really have this kind of started due to sort of like a takeover defense of sorts, if that makes sense.
Interesting. All right. So I'm going to go with 60% down the middle, because that's kind of like what the market is expecting. And we're doing like a market average rate of return. I have my problem with that statement, and everyone knows that at this point, because I've said it in so many videos, but I'll just keep it for the standards. And let's see 70, and let's assume like 80. 80, I think, would be really high, because that's compounded. So let's actually do like a 72. Let's not keep it too much. 72, I think, should be actually, we should make 70 the high point. 70 should be the high point, and probably around like 65. And then let's get a little bit more precise. Let's see if we can make it. Yeah, right there, around that. And then let's do on the low end. We'll keep your 6%. How about that? So we'll keep the 6%, but I don't think that's realistic for the growth rates that they've been showing us, because that's saying they're going to grow cash flows at industry average. And then you'll go to 40% around there. So like a really low number. So you can see here, if they only grow 40%, this is terribly overvalued, right? And based on all these assumptions I've laid out, the model is telling me do not allocate money to this company, right? At these rates. And it's telling me, I'm telling it my desire rate is 10%. My desire rate is 10%. Based on these 5 scenarios, and it's allocating the weightings evenly among all of them. So I'm actually weighting Austin's scenario equally to the others, and it's telling me do not allocate. But let's say I want to use the custom weightings. Then it says you can allocate a very small portion of your portfolio. Very small. You see how small that is?
Yeah. Wow. My goodness.
Yeah. It's basically saying, do not put too much. So if you're looking to make a required rate of return of 10%, now if we put that to 15%, you can see it says do not. Yeah. Don't buy.
Now I'm actually quite curious about this. So what was that 0.024? So,
if I go back, there it is, 0.24%.
Okay. So that comes out to about that. So that would be about
you don't have to say numbers, Austin, but
yeah, like a very tiny amount.
Yeah,
very
so
tiny.
It is a small portion of the portfolio, regardless, in a percentage term. So it's basically, in other words, it is telling me be very careful. The model is telling me to be careful. Like, for example, if I lower my threshold returns, you see it starts to increase the amount it says I can allocate to this company. Now it's at 3% allocation. If my desire is to make 5% per year, that's an implicit return of 62% over the course of 10 years. Now, if I want to say, you know, let's increase it to 7%, implicit return of about 100% over 10 years, I can put in 1.22% based on their risk profile of the business, et cetera. Now, let's actually see the company is not at risk of bankruptcy. The model is telling me that. But look at the analysts. This is very interesting. Analysts have this company at a buy and a price target of 95, implying a 43.9% return. So they could be doing that based on momentum, based on, you know, whatever wacky thing they're really doing.
Yeah, I was actually about to ask that too, because that seems almost contrary to what we're kind of finding here right now.
Yeah, so it could just be based on like some other metrics that they're using. So like maybe some momentum metrics, something like that. Whoever knows what analysts are really thinking. A lot of analysts, frankly, may not really know exactly what they're doing, but other analysts really know what they're doing. And then some analysts just play on the kind of momentum of the market and kind of play off of each other. So for all we know, it's an aggregation of what analysts think. And so if you think the analysts are right, Austin, do you think the analysts are right?
I'm not at liberty to say, but no.
Okay. So if you think the analysts are right, you're looking at a 43.9% potential upside, according to them. So not according to us. And let's take a look at the key ratios, see what we come up with. So balance sheet is pristine. However, it's not finding something. Remember what we found?
All of the operating leases.
No.
Right?
No. Something else we found. I highlighted it when we saw it.
It's the market cap.
Nope.
Cash.
Nope.
Then
preferred stock.
Ah, yes.
The preferred stock. So the preferred stock is debt, but they don't count it as long-term debt. So that's actually, it'll still be measured in the total debt ratio. So the total debt ratio will account for it within that. However, we're not going to be seeing it, for example, the long-term debt. The long-term debt is 0, but we know that they have preferred stock issued. So preferred stock is a form of debt because it's stock that gets basically perpetual dividends. And if you don't pay the dividend 1 year, you still owe them the dividend, right? So when you have the ability to pay, you know, they're going to get it. And you have to pay back the dividend and what you skipped over. If you have common stock and you don't get your dividend, they don't owe you anything. They don't owe you squat. All right. Does that make sense? Did I explain that well enough?
It does. Yeah. Yeah. That makes sense to me.
So I would be ignoring this earnings quality measure because this earnings quality is going out of whack because probably either the dual class. I know I like earnings quality, but I can't really use it.
Shenanigans.
A lot of shenanigans here, but not in a bad way per se.
Not nefarious shenanigans, but still shenanigans. You know?
Yeah. And then a lot of these are getting out of whack because dual class. When companies do a dual class like this, you know, it throws a lot of some things out of whack, and I'll point them out when I can. All right. So basically, a balance sheet looks pristine except for that preferred stock. So we want to keep track of that preferred stock. Gross profits are increasing. Margins are increasing across the board. Return on equity is coming down, though. Net profit margin was negative again. Now it's positive. And let's take a look at the activity ratios. We see negative cash conversion cycle. It's actually getting higher because the negative number is getting lower. So it's actually growing. And so that's not good, but it's still fantastic, right? But that makes sense because the time that they're waiting to get their cash is basically coming from the credit card company. So when you buy stuff from Chewy, you're basically putting your credit card on there. So it's fine. They're the retailer. So oftentimes they're going to be getting the money first. It's the places where they source the material that they might have a lower cash conversion, or sorry, in this case, a higher cash conversion cycle. And everything else kind of seems okay. Nothing crazy that's standing out to me. Some things are getting worse. Some things are getting better. Or is everything getting worse? Yeah, everything's getting worse. Everything's getting worse. So, but nothing that's sticking out to me as like something to be of concern, right? But everything technically is getting worse. Yeah, Yeah, it is. All right. So really, are you satisfied with what the models kind of spit out? Do you think any of these growth rates are off? We barely discounted it. All right. And we assumed
we didn't discount it at all.
Growth rates.
Yeah. Yeah. Our like typical standard is 10 and we're rolling with a 7 right now. So,
well, we don't like to do 10. If something is a buy at 10, that's not good enough for me.
Which is exactly what I'm saying here. It's literally beneath the 10.
But Austin,
there's no margin of safety here.
But Austin, it's analysts say it's a buy. 43.9% upside based on analyst price targets.
Stop, please.
Austin, I don't know. I don't know, man. You're kind of, what do you know, man? I don't know.
Yeah, I'm new,
You're wrong. The analysts are right.
So you're saying the price go up? Price always go up?
No. Price only go up.